Hello, I'm Mr. McCarthy, Coach McCarthy, whatever you want to call me is fine. This is 2.6 of personal finance. So in 2.1, we talked about describing sources of income. We talked about wages and salaries, and that's pretty much the main way that most people think of income is that they're getting a wage or a salary. We talked about passive income, and we like passive income because you don't have to do anything. Your money works for you. A good situation to get into. Talk about setting financial goals. They're important so that you know where you're going, know what you're doing, what your purpose is. We talked about looking at your financial needs and your goals to determine your financial requirements. So, how much money are you going to need? We looked at a financial analysis form, what those look like. We talked about establishing a financial safety net. Again, we look at probably 6 months as being what we're going to want to try and get to and how we're going to establish that financial safety net. For most of us, it's through some essence of a savings account. We did also briefly talk about maybe investing some of that money so that it can make more. And we'll get to talk about investing later on. But you do need to have that safety net just in case there are emergencies, whether you lose a job or have some kind of medical situation or something catastrophic in your life occurs. And then yesterday we talked about determining your personal net worth, and that's our assets minus our liabilities to see how much money we're worth. You need to know how much money you're worth in life. That helps you get to your goals, maybe to know if you've achieved one of your goals or what you can do with your life as you're moving forward. Do I have the assets? We talked about assets minus liabilities. Do I have the assets to be able to purchase a new house? Can I afford that as an asset? I'm taking on a lot of liability because I'm going to have to pay for it, but I can I pay for it? So today we're looking at describe the concept of insurance. Right. So this one can get really, really, really long, and we're going to try and keep it on the shorter side. We'll talk about insurance some more as we go. But basically, what we have here, and we're on Google, and that's our link there. Concept of insurance. So insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against losses from an insurance company. The company pools clients' risks to make payments more affordable for the insured. The one thing that we think about the most when we talk about insurance, and especially for you guys at a young age, is going to be your car insurance. All right, you're paying just in case something happens. I'm paying a little bit now, so they don't have to pay something major later. And that's probably the most simplest way you can think of insurance is that I'm putting a couple dollars down now, so I don't have to pay a whole lot of money later. And we'll go to Investopedia. We've been using them a lot in this class so far. So this is kind of what I just talked about. It's a contract. It's an agreement. The company pools the client's risk to make payments more affordable for the insured. Insurance policies are used to hedge against the risk of financial loss, so to try and help out with that. And kind of how it works. We all have a lot of different kinds. Most of us have auto insurance. You also have home insurance. If you have a business, you'll have to have business insurance to cover what's going on there if an accident's happen or something like that. You have life insurance, health insurance. We have that one too. Homeowners insurance, auto insurance. And here, the core component that makes up most insurance policies are the deductible, the policy limit, and the premium. So we're going to scroll down a little bit so we can talk about those a little bit more. So you really need to know how it works before you really make a decision. So the first one we talk about is the premium. So the policy's premium is its price, and that's typically expressed as a monthly cost, which you're paying over X amount of months. Now that could be a 12-month, that could be 6 month, it could be whatever. The premium is determined by the insurer based on your businesses or your personal risk profile, which may include your credit and a whole lot of other things. There's a whole lot going into them determining how to set your premium. And every company has a little bit different formula for how they're going to determine what your premium is. And your premium is going to be health insurance. I have a premium. I have to pay a monthly fee. Car insurance, which we can all probably relate to, you have to pay a monthly fee to keep your car, to keep it insured. And the more tickets you have, the more risky you are. So your insurance is going to go up. The more accidents you have, the more risky you are, your premium is going to go up. You're going to have to pay more monthly. So you might have to play around to find the right person, the right company for you that's going to give you the right price. So we have the policy limit is the maximum amount an insurer will pay under a policy for a covered loss. So we see this a lot with You can see this with medical when we look at our medical insurance. It is there on your car insurance also. Higher limits carry higher premiums, and that normally is true. We also have life insurance policies that we can talk about. And that brings us to the third one, the deductible. So the deductible is a specific amount the policyholder must pay out of pocket before the insurer pays a claim. Where you see deductible a lot, especially is with health insurance. If you go to the doctor, some of them have a deductible that you have to pay on site. As soon as you go to the doctor, I have to pay up front. I have to pay $20 to go see him right now. I have a daily deductible when I go to the doctor. Now, every insurance could be a little bit different. Yours might be higher. Yours might be lower. And then also, when we have a procedure, we have a deductible, and every insurance policy is a little bit different. Typically, with insurance policy, the more you pay upfront, the less you have to pay later on, and that's kind of affected by your deductible. So, if I pay more now monthly, I might have a lower deductible later. If I pay a low amount now, I'm probably going to have a higher deductible later. One way or another, that insurance company is probably going to get their money. So some other things, and it talks about health insurance with chronic health issues or need regular medical attention. Should look for policies with lower deductibles because you're going to be going a lot. You don't want to have this high deductible that you're paying out of pocket for a lot. Let's go back to our other thing here and see what we've got. And we clicked on this one earlier, Wikipedia. So same things that we've talked about. Insurance is a means of protection from financial loss, form of risk management, primarily used to hedge, and we talk about hedge against the risk of a contingent or an uncertain loss. You're trying to protect yourself. An entity which provides insurance is known as insurer, the insurance company. That's what we know them as. An underwriter. We don't use here this term quite as much, maybe more so in the business, but the insurance company. And then the person or entity who buys insurance is the policyholder. All right, so let's go back to our slides and we talk about principles of insurance. Um, so when we talk about principles of insurance, we're going to go for a visual here. It seems like there's kind of 5 or 7. Everyone kind of has a little bit of different number, but like we see here, 7 basic, 7 principles of insurance, and 7 principles of insurance. So, good faith, insurable interest, indemnity, principle of contribution, principle of subrogation, principle of loss minimization, and principle of causa proxima. Okay, a lot of words in there that we don't really use on a daily basis. So let's see if we can't go and find just a little bit more about it. So here's the kind of what we were talking about. Understanding how insurance contracts work, very beneficial when you're deciding if you need a lawyer after a car crash or other serious personal injury. So here's our 7 basic principles that we talked about. And this is a good website, this McMinn Law Firm, and they explain a little bit more what each one of these means. The good faith, both parties involved in an insurance contract should act in good faith towards each other. All right, insurable interest just means that the subject matter of the contract must provide some financial gain by existing for the insured and would lead to a financial loss of damage. So something that's going to get the insured must have an insurable interest in the subject matter of the insurance contract. Indemnity is a guarantee to restore the insured to the position he or she was in before the uncertain incident that caused a loss of the insured. So that's the insured, the provider compensates the insured, the policyholder. So I'm going to get paid if something happens. And then we have contribution. We have the principle of subrogation. Then we have the principle of proximate cause, the principle of loss minimization. And like it says, that is what makes up the insurance contract. So there's a lot of things going into insurance to try and make it work, right? Sometimes you have to pay a lot of money and you don't really reap the benefits. And sometimes you do have to reap the benefits. Especially with medical, you might not need it for a year, but then the next year you might need it a lot. All right. So, and just understanding that you do have to have insurance, and every company is going to be just a little bit different for how they're going to put it together.